Why are billionaire fund managers secretly loading up on two sectors that most retail investors won't even touch? I stumbled across something strange last week while analyzing institutional buying patterns, and what I discovered doesn't make sense at first glance. These two ETFs have been quietly soaring while everyone's obsessing over SCHD and SCHG, but here's the weird part: they're still trading like nobody wants them. There's clearly something these institutional investors know that the average person doesn't. And by the end of this video, you'll have the same information they're using to position themselves for what could be the biggest sector rotation of the decade. Picture this scenario that every investor faces. You're standing in front of two doors, and you have to choose one. Behind door number one is the momentum trap. These are the high-flying stocks everyone's talking about, the ones that make you feel like you're missing out every single day. Sure, they have strong fundamentals and market sentiment, they just keep soaring higher and higher. But here's the catch. When you finally work up the courage to buy them, you're typically paying what many would consider an outrageous price. You're essentially overpaying and hoping that the momentum carries you even higher so you can somehow time the perfect exit. It's like trying to catch a rocket ship that's already halfway to the moon. Behind door number two is the value trap. This is where you're buying companies or funds that appear undervalued, trading at what you believe is less than their intrinsic worth. The hope here is that you can be patient, wait it out, and eventually the market will recognize what you saw and reward you handsomely. Your downside risk feels limited because you're buying on a value basis. But here's what they don't tell you. This approach typically requires an iron stomach because you're almost always buying companies or sectors that are completely out of favor. The fundamentals might look terrible, everyone hates them, and you're constantly wondering if you're catching a falling knife. You run the very real risk that the market actually knows something you don't, and what you thought was a bargain could fall much, much further. Remember when everyone thought banks were a steal in 2007? This cruel choice has been tormenting investors for decades, and both approaches have their serious downsides. But last month, something happened that completely changed my perspective on investing, and it might just change yours too. I discovered something that most investors don't even realize exists. There's actually a third option, a holy grail of sorts, where you can find sectors that are absolutely soaring with incredible momentum. But here's the kicker, they're still deeply undervalued. It's like finding a Ferrari priced like a Honda Civic. These opportunities are incredibly rare, kind of like buying Nvidia when it first started to turn the corner and zoom higher. If you had the vision back then to recognize that we were just at the beginning of this massive AI revolution and that Nvidia was going to be the king of that castle, you could have made life-changing money. Yes, you would have been buying a stock that was already hot at the time, but it had so much further to surge that the early entry price looks like pennies today. This window of opportunity won't stay open for long, and I'm about to show you two sectors where this exact scenario is playing out right now. Let me take you back to March 2020. A time that will forever be etched in the memory of every energy investor. Oil prices didn't just fall, they went negative. Think about that for a moment. Producers were literally paying people to take oil off their hands because there was nowhere to store it. It was like a scene from an apocalypse movie. Energy investors were jumping ship faster than passengers abandoning the Titanic. The panic was unlike anything we'd seen since the Great Depression. MLP, the Illyrian MLP ETF, crashed harder than crypto in the worst bear market you can imagine. The entire energy infrastructure sector was left for dead, and most investors wrote it off permanently. But here's where the story gets interesting, because something incredible started to happen that most people completely missed. The economy began to reopen, oil prices started to recover, and demand came roaring back stronger than anyone expected. Then came the geopolitical shock that changed everything. Vladimir Putin invaded Ukraine in early 2022, and suddenly the entire world woke up to a harsh reality. We couldn't just passively depend on potential adversaries like Russia for our energy needs. The United States and Europe realized that energy independence wasn't just nice to have, it was a matter of national security. This wasn't just a temporary shift in policy, this was a fundamental restructuring of how the world thinks about energy. But the transformation of these companies during this period was nothing short of remarkable. The difficulties they faced during COVID and the threats from renewable energy and ESG investing movements forced them to become incredibly disciplined about their finances. They slashed leverage, cut unnecessary capital expenditures, and started generating massive amounts of free cash flow. Most of them became completely self-funding for their capital programs. They achieved investment-grade credit ratings with leverage ratios that were materially lower than they had been in years. They started covering their payouts very conservatively with cash flow, buying back units, investing in high-return, low-risk projects. These weren't the same companies that had crashed in 2020. They had evolved into cash-generating machines. Then came the AI boom that nobody saw coming, and this is where the story gets really exciting. Every time you use ChatGPT, every time an AI model processes your request, every time a company runs machine learning algorithms, massive data centers are working behind the scenes, and these data centers are absolutely hungry for energy, specifically natural gas. Companies like Enterprise Products Partners, Energy Transfer, Enbridge, Williams Companies, Kinder Morgan, and TC Energy are all positioned to benefit enormously from this AI-driven demand for strategically located natural gas infrastructure. This isn't some distant future possibility, this is happening right now. On top of that, you have an export boom to countries in the Far East and Europe who are desperately wanting to import more and more LNG from the United States. Companies like Enterprise Products Partners and Energy Transfer have been benefiting significantly from this trend. And now, with President Trump back in office, his administration has been incredibly supportive of the U.S. energy industry, especially hydrocarbons. He's directed his departments to be very friendly to new infrastructure projects, which opens up even more growth opportunities with less regulatory risk. Here's what's absolutely mind-blowing about this situation. Despite all of these incredible tailwinds, despite the sector's amazing performance, despite the fundamental transformation of these companies, AMLP still yields 7.9% today. Think about that. You're getting paid nearly 8% just to hold this fund while all of these positive catalysts are playing out. The top holdings like Enterprise Products Partners, Energy Transfer, MPLX, Plains All American, and Western Midstream all have guidance for pretty strong distribution growth for the foreseeable future. MPLX is literally saying they expect to grow their distribution at a double-digit rate for the next several years. When you couple that high yield with highly contracted cash flows, strong balance sheets, blue-chip holdings, and all these macro tailwinds, we're looking at probable low to mid-teens total returns just from distributions plus distribution growth. But if we see some yield compression, especially if interest rates start to fall, or if we see valuation multiple expansion from growing market bullishness on the AI boom, we could be looking at much higher total returns than even that. Now let me tell you about the second opportunity that has me even more excited, and it's hiding in plain sight. Gold has been on an absolute tear for the last several years, really since the fall of 2022. But here's the mystery that most investors haven't figured out yet. Gold mining stocks, specifically the blue-chip miners and VanEck Gold Miners ETF ticker symbol GDX, have barely kept pace with gold itself. This creates one of the most compelling investment opportunities I've seen in years, because gold miners should be dramatically outperforming gold when the metal is rising. Here's why this is so important. Gold mining companies have massive amounts of fixed costs. When gold prices rise, every additional dollar goes almost straight to their bottom line because their cost structure doesn't change much. It's pure leverage to the gold price. When gold moves up $1, miners should theoretically move $3 to $5 because of this operating leverage. But that hasn't been happening, which means we're sitting on a coiled spring that's ready to explode. GDX gives you exposure to some of the best mining assets in the world through companies like Agnico Eagle Mines, Newmont Corporation, Barrick Mining, and Silver Wheaton. These aren't speculative junior miners. These are blue-chip companies with world-class assets. And if you look at GDX's performance year-to-date, it has absolutely crushed the S&P 500, but I believe this is just the beginning of a much larger move. The fundamentals of the gold market have never been more compelling. We have runaway deficits in the United States, Europe, China, Japan, and basically every major economy in the world. Fiat currencies are not doing well right now, and gold serves as the ultimate hedge against monetary debasement. You have massive geopolitical risks with China, ongoing tensions in Europe with Russia, and instability in the Middle East with Iran. Each of these situations creates another reason for investors and central banks to seek the safety of gold. Speaking of central banks, they have been buying gold hand over fist, moving away from the dollar and toward gold as their preferred store of value. This isn't retail investors making emotional decisions. This is the smartest money in the world making calculated strategic moves. When central banks are dumping dollars for gold like it's 1979 all over again, you know something fundamental is shifting in the global monetary system. But here's what makes this opportunity even more compelling. The underlying companies in GDX have transformed themselves just like the energy companies did. Take Newmont Corporation and Barrick Mining, for example. These blue-chip miners are turning a corner in their fundamentals and generating massive amounts of free cash flow. Newmont is buying back significant amounts of stock. Barrick has been doing buybacks as well, and both are paying dividends while ramping up growth projects. They're getting growing exposure to copper as well, which is another incredibly exciting investment opportunity given the electrification trends happening globally. Yet, despite all of this positive momentum, these companies trade at huge discounts to their historic price and valuation multiples. With all the free cash flow they're generating, both Newmont and Barrick are highly compelling buys, even though they're some of the largest constituents in GDX. There are other miners in the fund like B2Gold that I think are also still very undervalued and highly compelling investments. What we're witnessing right now is the same type of opportunity that made Nvidia investors incredibly wealthy. We have two sectors that are soaring higher with strong fundamentals and positive market sentiment, but they still have much further to run because they remain deeply undervalued. The smart money is already starting to rotate into these positions, and both AMLP and GDX have been crushing the S&P 500 this year. But I believe we're still in the early innings of much larger moves. The window for these types of opportunities doesn't stay open forever. Market efficiency eventually kicks in. Valuations get bid up to fair value, and the easy money gets made by those who position themselves early. The question isn't whether these sectors will explode higher. The question is whether you'll be positioned before they do. If this analysis has opened your eyes to these opportunities, please hit that like button because it really helps get this content in front of more investors who need to see it. And if you want to stay ahead of the curve on opportunities like this, make sure to subscribe to the channel because I'm currently tracking 12 more situations just like these two, and you definitely don't want to miss them when I share my research. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.